All right. Good morning and welcome to all of you that are joining us for free this morning. We appreciate that. This is our morning meeting where I go around the horn, tapping each sector head for their intelligence on what's going to be news ostensibly in the future. So again, trying to get you long and short, or if you don't short stocks, just get out of stocks that we don't like. And you can do that too. Do it for your family. And we'll go on with the day. The top three things, by the way, this morning that I wrote about in our subject matter for the macro show will include going 3 for 3 in Asia, Philippines, India, and of course, long of Australia. All those things. Again, we have a go anywhere strategy. We're not one-dimensional CNBC moving monkey types. If you can do that, if you can read what an ETF is in the Philippines, you can buy it for your family too. So that was their short commodity still in volatility. Actually broke down on my trend signal, which got us to buy SPLV or more of that. It's been an asset allocation. S&P, not SPY Monkey, S&P low volatility, SPLV. Super hot pick for you there, for your family, BLC. What's up?
Good morning, Keith. All right. So every year, retailers reset their shelf space. Generally, the big one is in the spring, generally awarding that valuable real estate in the coolers based on sales velocity, but there's some other metrics, but that's the big one. And that's it sort of reinforces who was doing well last year. You get more space this year. If you weren't selling, you lose space, et cetera. So just to give you a backdrop, total beverage sales last year grew 5.1%, according to NIQ. Total beverage alcohol was basically flat, down 0.2%. January itself was down 0.2%, with volumes down 1.9%. And total beer sales were flat in January, with volumes down 1.7%. So not a lot of change there, right, for beer. And beer was only up 0.1% last year. So not a great starting place to sort of keep that space. And within beer, of course, we had one of the most dynamic changes we've ever had last year. So beer, if you didn't know, is the leading beverage category in sales. It's 23.9% share, but it lost 0.6% points. And that's to both soda and energy drinks. And that's why I think you've heard me talk so much about energy drinks. So beer is at risk of losing shelf space to these faster growing categories. Soft drinks is about 20% of all beverage sales. Energy drinks is already at about 10. So Bud Light is at the risk of losing the most shelf space in these spring resets, and that's the big concern there. And Celsius, CELH, the ticker, that's what I'm long, is positioned to be the biggest gainer in that shelf space. And then today, interestingly enough, we have a post from our old president, Donald Trump, who said on his Truth Social that Bud deserves, perhaps Bud deserves a second chance, and that it is a great America brand. He goes on a little bit longer about the things the company does. The big one is like Fold of Honor. You're going to see advertisements for that in the Super Bowl, supporting veteran families. So the shares are up this morning because I think the perception is that Donald Trump is going to pull off some of the negativity off the brand. But, it'll be interesting to see that. All year, Bud Light sales have been down about 29%, no matter what's happened, no matter if Kid Rock says something or someone else does something else, or whatever commercial they run, whatever promotion they run, they've been down about 29%. So it's interesting that the timing of this, they're making a big push for the Super Bowl. They have more commercials than any other beverage, probably anything else than I follow, maybe even the most of all advertisers. And we'll see if that helps them with their spring resets. I think it definitely will help on the year-over-year comparison. I think his post is enough for that. But Bud is still sort of fighting gravity once you get that initial easy comparison. And it'll be interesting to see what kind of a change it has in the weekly sales cadence. But Celsius, outside of all that controversy, there's no controversy with Celsius. It's just gaining share because of the sales velocity is so good. So I think that's the easier call on the spring shelf reset.
Yeah, Celsius, for those of you that don't know the name, CELH is the ticker. And then, Budweiser, whether you like Trump or not, doesn't really matter. The signal doesn't care about your feelings. The signal actually believes this. So Budweiser, for the first time on, the signal's built, for those of you that don't know, on price, volume, volatility. That's a much better way than being a single factor moving monkey, or I wouldn't call it a single factor moving monkey. For those of you that don't like me, but you're on for free, good morning. Price volume volatility, PVV, 3-factor model. So when the price breaks out on accelerating volume like it did yesterday, that was one of the biggest volume days that Bud's had in years. So I guess my question to you is, because you've been bearish on it fundamentally and accurately so, I mean, what's the first quarter where they lap the disaster? Because eventually it's just the comps anyway. I mean, it doesn't matter. If the signal's bullish and they're lapping the easy comps, I mean, I'd buy it.
The whole thing started about early April.
Right. Okay. So early April of last year. So if you're a bear, you basically have Q1 as your last tough comparison, and then it's easy comps. Right?
Yes.
See, I can count. Okay, good. I got it. All right. Penny, I saw you jump on. I don't know if you're on or not. Maybe you're just listening in.
Hey, yeah, Keith, sorry, I got on. I know I got on as you were going through your preamble.
Thank God, because
so,
I got a super hot penny stock pick for everybody who's new here. They love penny stocks. And I'm not just talking Howard Penny here. I'm talking a penny stock. The Gram, GRAM. That thing was right at the low end of the range yesterday.
Love the Gram.
With the rest of your cannabis stocks ripping. So I don't know. I mean, well, I don't care why it's at the low end of the range, but you still like the penny Gram, right?
I do. I actually spoke to them yesterday.
Really?
And everything is going well. Yep.
Really? Yep. Who's the? I mean,
I did.
So those of you that think that was staged, get over yourself. It wasn't.
No,
I don't know.
It totally wasn't staged. It just, I'd like to check in with smaller companies like this, just because there is, the need to, and because I said this in the deck that we did on Graham. I am betting on Lori and her success that she's had in the space and growing this company, and so checking with her is important.
Indeed. All right.
It's just. But so there was a lawyer, Adrian Sneed, yesterday, who put up he wrote. I'm not going to get this completely accurate, but I'll get the context right. He is a Washington, D.C. lawyer. He's drafted some cannabis reform, like Safe Banking Act, and he's a heavyweight, if you will, in cannabis Washington, D.C. stuff. So he put on LinkedIn yesterday, something is coming soon.
Yeah. Okay.
Okay. So whatever that means. And so that set off a flurry of activity because he's in DC and, he's been involved and around, and he said something is coming soon. So the Biden administration denied it, but it's not the Biden administration that could, we're not waiting for the Biden administration, right? We're waiting for HHS to come out and basically signal that cannabis is going from Schedule 1 to Schedule 3. So it's the Biden administration said nothing's coming, but who cares, right? We're not waiting for the Biden administration. We're waiting for it. So anyway, that's what got the stocks up yesterday. And anyway, for what that's worth.
My signal had a pretty good little sniffer on the GTI and the green thumb. We hit the button in real time alerts. For those of you that don't know what that is, that's where if I get something, which is not every day, at near the low end of the range, like GTBIF did yesterday, and I see the volume picking up and my signal again, price volume volatility. I hit the button, so I guess somebody knew something. But this is par for the course, right? I mean, insider trading by people in Washington is live and well, and they know the catalyst is coming. So we've been long ahead of that for a little while now. I can't believe we started the call with the first time it's been free with Trump and Biden in the first two segments. Good.
And,
all right,
I just also on the reference space, the tough comparisons are center stage for every restaurant company. So Chipotle put up a decent quarter, but clarifying comments, the first quarter sucks and inflation is coming back, frankly, or not coming back, but there's still inflation in the restaurant industry, labor, food. So yes, a lot of these companies are putting up decent quarters, but as I said the other day, job growth is slowing, sales growth is slowing for the industry. And, that's our economic reality that we're having to deal with here in the first quarter. And to Daniel's point about Super Bowl ads, DoorDash is making a huge push, which I wrote about this morning, this Super Bowl, where you have a chance to win. If you watch their ad, you have a chance to win everything that is advertised on the Super Bowl. But you got to pay attention. You got to pay attention.
Whatever Dash.
I wrote about it. It's really complicated. Like this is, I mean, maybe I'm making too much of it, but I wrote about this morning how you can take advantage of the DoorDash ad and what you need to do to win a lot of stuff. So they're making a big push in the Super Bowl.
That signal, despite it being bearish long term, it's bullish trading trend. So people are, a lot of these, higher short interest stocks have had a good move here, and it is what it is. He didn't say Jordash like the jeans. I know it sounds like that. It took me years. DoorDash, DASH. All right, good. Thank you. And again, I had this comment from a subscriber on Twitter. He's like, "Look, I've been a subscriber for a long time. I love it, but I'm getting confused." And that's the confusion is only by overthinking it. Okay. If you're overthinking it instead of just hitting the bloody button, you're like I played with a lot of talented hockey players that really suck in the game because they can't make a decision. They overthink it, they overhandle it, the puck. It's like just execute. If on one side of your brain, and I get that my advantage is very clear. God gave me the ability to be dumber than most people, so I can really kind of not overthink it. But if on the one hand you can hear Penny say what he said about labor and what's going on internally, which is bearish for a lot of companies. The Russell 2000 is, earnings are down 46% this year over year for that reason. But there are a lot of other companies that are not seeing that. So be long the good ones, be short the bad ones, get over it, be able to take in economic data that's bearish and still be bullish on cannabis. Okay. It's not that hard when you just put the positions on, because if they go up, it's easier to see in your account. All right. Thank you. Jenks, you on?
I am, Keith. Got a few things to hit on. So we just put out something on the OTAs, but I think I'm going to leave that to tomorrow to discuss because we'll have Expedia after the close tomorrow. But yesterday we had also put out a deep dive research piece on the Las Vegas Strip. Yeah, and part of that research piece was actually in conjunction with our awesome communications team headed up by Andrew Friedman and looking at some new tracking data. So really the bottom line and the main takeaways from the note are, as we look out into the year of 2024 for the Las Vegas Strip, you could see really steep comps both on the visitation growth side and then more importantly on the RevPAR side, so revenue per available room on the hotel side, which drives a significant amount of the EBITDA in the market. Gaming is also good, but focusing more on the non-gaming segment for this specific piece. But as we look ahead, we're pretty optimistic that the market has three key drivers really for growth to continue in the new year and potentially beyond. But really, what we're focused on is 2024. So if you think about, and this is I think a unique data edge that we do have as it relates to forecasting the market. So for starters, we look at the convention calendar and then sort of roll up and look at all the major conventions and group meetings that are coming into market. Look at the expected attendance, then track versus actualized attendance, and then we can forecast that out for the next 12 months. And so for that point, convention calendar looks really packed in nicely. Attendance so far in the year to date for an event like CES, which was earlier in January, attendance actually came in nicely higher than expectations. We had Felix out there. He gave me some boots on the ground insights, but attendance is tracking nice. And then importantly, booked events are tracking well ahead of the prior year and also ahead of 2019 same time. So, that's going to be a nice component to visitation growth. International airlift coming back into the market, and that business is still well off pre-COVID levels. So that's a big driver for the recovery in the year ahead. And then importantly, for what we introduced yesterday, we added some data capabilities on the leisure event side. Think about, obviously Super Bowl is the marquee event that most are focused on this week. It's in Vegas. There's a lot of buzz around it, but outside of Super Bowl, there's a lot of interesting activity going on in the market. There's more events at T-Mobile outside of just the Golden Knights. You have more shows coming into Allegiant. Obviously, you do have Super Bowl. And then now the Sphere is actually, that big orb thing that we saw when we were out there in Vegas, adding some nice incremental event flow to the market. So you got U2's residency, which will then go over to Fish, and then you got Grateful Dead. Not necessarily my favorite bands, but I know we have some folks at Hedgeye that do enjoy those bands. But either way, there's a lot of activity going on in the market. And really that's the leisure event calendar is really something that, that's going to kind of sway your view one way or another on visitation, just because it's such a large component of visitation. But as best we can tell, quality events are up for the first half of the year at least, which is kind of the max lead time that you really have to assess that kind of data. And then also the volume of events. So more volume, and then also the quality of events tracking higher. So all told, we're looking at a RevPAR forecast for this year in the 4 to 6% range, which should translate mostly over to MGM, Caesars, and Wynn. You might have Wynn a little bit lower because they have tougher comps, but MGM should be performing right in line with the market, and that compares to consensus thinking that the setup is more like a 2 to 3%, even 1 to 3% growth here on the RevPAR side. So that translates into our upside on EBITDA expectations, and obviously why we still have the stock as a best idea long, and really at the top, or close to the top of our long buys list, or our best idea list. So that's Las Vegas. Really like what I'm seeing there. And then if you had any questions before, I wanted to just hit on Hilton, because they were the first big company to report in my space. I can run through that.
No, just a comment, man. Like, we got a big audience here. Like, the one way to lose people is to say you like Biden or Trump, or say you don't like the Grateful Dead. Like, just stop. Okay.
Hey, I like that people are so excited about it, and it's going to draw people to Vegas. And I like the fact that, importantly, that we can track that data and we can see what kind of visitation flow it's going to bring into the market. But anyway, maybe I need to give them another chance.
No, the thing for those of you that are used to watching like the Clown Network, I mean, our analysts have these things called models. Like, they model the company, like not like Drawdown Josh Brown, who had you buying like Snapchat and the New York bank that's down another 25% more. These people have no models. They have no process. They have no experience. They're clowns. And if it sounds critical, it's because it is. We're serious about your money, your hard-earned capital. We have serious people and serious models. Expedia, for example, that one, you can hit on it quickly on a yes or no, because you want to hit Hilton, and then we got to get going here. But I was looking at my Expedia signal. This thing looks like it's going to rip towards 200. I mean, this thing, if you're right, how much higher are your numbers, by the way, quickly on Expedia for the quarter than the streets?
For the quarter, we are 7% above on the EBITDA line, about 3% above on revs. And then basically an equivalent amount on bookings. But importantly, that's enough that, it's going to imply actual acceleration from the prior quarter, where they had guided to an inline growth rate. So I think that's the incremental, is that you're going to have accelerating growth coming out of the year. And I think the outlook based on the Jan data, and we're jumping ahead to what I was going to talk about tomorrow, because we just put the note out. But since we put it out, we can talk about it, obviously. The data in January was actually really strong as well. And then within that, the components of the data. So what we're seeing out of the Expedia brand, specifically in hotels.com, really driving the bus. Vrbo is still dealing with some tough comps. And that's sort of that's unique to alternative accommodation in the domestic market, which Vrbo mostly caters to. But the rest of the enterprise is firing on all cylinders. And 200, that's interesting that you would call that out. That's sort of where I would peg it in terms of upside. Stock's always going to be cheap. It's a lower quality name versus, say, a Booking or a Hilton, which I'm going to talk to. But importantly, that the rate of change in the P&L is all positive and going in the right direction. And you got a CFO that is buying the hell out of her stock because she thinks it's cheap, and she has a history of doing that at Williams-Sonoma. And Brian had told us about her and said, watch out, she's a good hire. So, and she has been, so far. So I like the setup into that one's tomorrow.
I used to be along Williams-Sonoma when she was
Julie Whalen.
It's Sharon, right?
No, Julie Whalen.
Oh, different person. And there's a different person.
I guess so.
Expedia, by the way, the ticker is EXPE. And these types of setups, when it's signaling bullish trade, bullish trend, higher highs in the range. Okay, that's a mathematical fact. But also on the look back, like there are a lot of stocks that make new all-time highs every day, like Nvidia, obviously, which we're also bullish on. But this one's all-time closing highs $213. So 200 is conservative. I mean, it's called mean reversion. So again, and there's been big time moves in names, when they're accelerating in a growth slowing environment. So that's what that is. But again, thank you for just the very basic difference, right? If you're watching these monkeys, like they're going to say, well, expectations are they'll just read it off Yahoo Finance when they're commenting on a stock, right? It's useless, right? Tell me what's in your model, then we'll start to have a discussion. Tell me what my signal says and your model, and we'll have a real discussion. It's just a better way, right? All right, wrap up on Hilton.
Yeah, Hilton. So, real simple. Hilton doing its thing, beats across the board, and importantly, on the franchise fee side, which really is sort of the meat and potatoes of how a franchise business operates. So they didn't beat, pulling SG&A or anything like that. It was a clean beat with real solid fee growth. But importantly, the guidance for Q1 a little bit higher, but for the full year, nicely higher than the street, and a lot of it coming down to their net unit growth guidance. So that's them putting new units, or their developers being able to open new units. So that number is actually going to accelerate from the high 4% range, which we had this past year on the hotel side, and that's going to accelerate to 5.5 to 6%. Usually, if Hilton's saying 5.5 to 6% growth, that means north of 6, which is sort of where we had pegged it. We had done a piece, a deep dive in comparing Hilton and Marriott, and oddly, they trade at comparable valuations, but they are in no way, shape, or form comparable in terms of growth algorithm, and importantly, organic growth algorithm, where Hilton totally dominates in that segment. So their call is later this morning at 9:00, but really solid setup, and importantly driven by that net unit growth side of things, and not pulling cost levers and what have you. So real high quality beat management team and guide for the new year. So TBD if there's anything incremental coming out of that call, but at first blush everything looks good.
All right, good. We took up some airtime there, but it was worth the time. All right, stock picks. McGough.
Yeah, good morning, Keith. So I got a few things I want to hit on. First thing is our Deckers Black Book at 10 a.m. today, which I'm pumped about. It's a really good deck. It's a short call. If this is the best idea short, it's #1 on our list. I've got bulls who are telling me, hey, this company's playing a different game here. People are going to start talking about $50 in earnings power. I will fall out of my chair if this company puts up a $50 number in earnings power. That is admittedly what you have to be playing for if you want to be buying this stock right now. I think there is a very high probability that this stock sees 500 before it sees 1,000, which is where it would trade. If it did $50 in earnings power, I get closer to $30 in earnings power. The stock's now at 825, so I think it's going to 500, which is certainly worthy of a best idea short. So we got that presentation at 10 a.m.
Ryan, where's on your model? Where's the street for 2024 earnings and what's your number?
Their 2024 ends in one quarter, so they're off, but we're about 10% lower next year. And by year 3 of our model, we're 30% lower.
Okay, so your call is that, yeah, thanks for the blazingly obvious. They had a good run, but they're about to print their peak earnings and roll over. Whereas the consensus is hoping that they hit new highs and buy a lot.
Right, and his CEO is leaving. So it's like this he's only 58 years old. I could say only because I'm across the 5 threshold with my age. But that's kind of young for a CEO whose business is ripping, and this guy's leaving while they're on top. And I don't think he wants to be there next holiday when they have to comp on UGG, this company. If you don't know Deckers, it owns UGG and Hoka, which are 2 very good brands. I have nothing against them. I own them both. But the fact of the matter is I don't want to own the stock. I want to be short the stock. because I think the rate of change is gonna not go in its favor, and we're gonna outline why in our deck.
Good. It's nice that you're not like drawdown Josh Brown. You know, if him and his homies wears it, they're along the stock and they eat it or whatever it is. It's just stupid. All right. What else?
So just while we're talking about the footwear complex, you also want to be short ON on holdings. I know everyone loves those sneakers, but tough shit. Stock's gonna blow up this year. So I think you get paid in one day on that one. If you want to be long anything against those two shorts, you want to be long Nike, NKE, Skechers, which I actually have above Nike on my list, SKX, and amazingly enough, Foot Locker, FL, which I've been doing this for 30 years, and this is, I think, only the second time in those years I've been long Foot Locker. But one footwear company that reported earnings last night is VF Corp, VFC. This is a name we're short. I don't know if you recall this, Keith, but I kind of do know you recall it because you've got a memory like an elephant. But your signal sniffed this one out about a quarter ago. We were long it for a hot minute and we turned and went short. The company came out, it missed EPS by a country mile. It's all of its brands decelerated. Its biggest brand is Vans, the shoe brand Vans. And it went from a down 22, which is already an astronomical number, to a down 28 comp, which is just so huge. Timberland was down, North Face was down. That's the 80-20 rule, that's 80% of its cash flow right there. The problem here is that this company has massive debt maturities coming up starting in 2024. And it's not even like there's one big one and then a little one. And then it's like every year this company's got $400 to $500 million it's got to pay. So you have a company that's got both a brand problem and a balance sheet problem. That is a problem. Because that's a very big problem, because you can use your cash flow to do one of two things: either reinvest in your business in SG&A, which is the only way to get brands going again, especially when Nike is eating your lunch, which Nike is killing Vans right now in the skate business. Or you can go to fix your balance sheet. And this company has got to pick one of those two things. And it's going to have to pick its balance sheet first, which means its P&L is just going to continue to melt down. I think the end result here with the stock, which people are telling me, oh no, Brian, it's cheap. It's only trading at 12 times earnings. Well, my answer to them is, A, I don't care. B, it's trading at 12 times EBITDA. So anytime you have, this is like a rule in retail, if you have a company's EBITDA multiple that's equal to or greater than its PE multiple, there's generally a problem. And that's what VF Corp has right now. I think someone is going to force this company to sell one of its three main brands in order to pay off its debt or a part of its debt. So the way to fix its balance sheet is to sell a crown jewel that otherwise would be fixable. So anyway, this stock closed yesterday at $16.95. It's now trading down 11%, 15, 14, and there's no reason why this can't and won't be a $10 stock. So we're short VF Corp and we're staying short VF Corp even on this sell-off. And then just last ticker I want to hit on here is something Jeremy touched on yesterday, TCS, the Container Store. This is a name that is on our long list, but Jeremy had a very clear message yesterday. He said this company will miss. So you don't want to be long companies that are going to miss, and they came out and they missed. So good call out there on Jeremy's part. I've got to decide what I want to do with this stock. It's a loser. I don't like staying with losers. One thing this company did is it pulled its unit growth for 2025 because of cash flow. So a classic example of a company that doesn't have enough cash, can't reinvest in its business, And the reason why we're in this is for the upside with unit growth. So if one of the key reasons why I'm long it just got pulled, I got to decide whether I want to be long it or not. So stay tuned on that one, but nice call on Jeremy to throw out a red flag ahead of the quarter on the call yesterday morning. Hopefully, if anybody was bag holding that one, they got out, because that stock is also down about 10% this morning. And that's all I got for you.
Yeah, get the losers out of your life and out of your portfolio. It's a thing a lot of you are bad at. It took me a decade to learn it myself. So again, cut losers, ride winners. Got it? You got it. Riding VF on the short side's been great. All right, we got to hustle up here, Tom.
Yeah, nothing for you today, Keith. I'm going to go through CVS here in a minute. But other than that, the guidance looks weak, but I don't know much about it right now.
Yeah, get back to me on Regeneron, right? REGN, it's signaling buy, and it spent the day at the low end of the range, but I needed, like, back to the point, I need some research, right? to say that you like it. And I know it takes more than a day. We obviously sometimes it can take a week, but the market doesn't really care. It waits for no one. All right, Emily.
Move on. I'm okay this morning.
Man, like, it's a free one, and you're the coolest cat on the call. Like, people want to hear from you, right?
Well, I was going to mention CVS because one of the and I'm going to talk about this next week on a call, Keith. We have a situation where the medical loss ratio for these insurance carriers is going up, but a lot of it appears to be what your exposure is to the Medicare Advantage market. That is old people. And we're seeing, valuations on the private side for some of these high flyers really coming in. And the problem here is that there just aren't enough old people to go around. And what you need is a nice supply of 65-year-olds coming into your bucket to offset the now bolus of people who are 73, 74, 75. That's when you really start spending the money on utilization for patients. And the 1947 cohort was one of the largest birth cohorts in the history of the United States. And it turned 65 in 2012. And now it's aging into its high utilization years, which is going to be a problem in the Medicare space for a while. This, of course, is great news for the service providers, as Tom keeps pointing out. But this handling those demographics is not going well for everybody. And CVS is one of those. And let's face it, CVS, they're a retail operation, and what they do as far as healthcare goes is to drive people through their stores, and that's becoming less and less a viable plan. And that's it.
Yep. And for those of you that couldn't tell, that's Emily's coming to you from our Tennessee office, and I'm coming to you from the car. If you didn't notice that, I'm big time, right? So I got like a multi-million-dollar BMW deal. Just full disclosure. Kidding, not, but fill the bucket. There's a song, and it might be it's got to be. It sounds like a country song. Like, when you can't put, like, you got to fill the bucket. You said with 65-year-olds, right? The song. Yeah. There's a song. There's a hole in the bucket, dear Liza, dear Liza. There's a now that's what people really pay for, is me singing. There you go.
Yeah, boy, you're really digging into the old time there. That's deep into the discography.
Steiner, am I scaring you, man?
A little bit. Good morning. So yeah, I've got a couple things just to roll through quickly here. First off, just on a calendar basis, next week on Wednesday, Valentine's Day, we're going to be hosting our Q1 macro themes mid-quarter update call at 11 a.m. So put that on the calendar. We'll have that invite out either tomorrow or Friday. Two other things, or I guess three other things I wanted to talk about each quickly. One is, The regional bank space a year ago got very interesting, obviously. We had a number of regional bank failures, essentially driven mainly by interest rates and underwater marks on the securities portfolio. Ultimately catalyzed by Silicon Valley having just a massive concentration of depositor risk. Where we are today, a year later, almost a year later, is that the credit concerns have sort of bubbled up in the regional bank space, and they revolve primarily around the segment of commercial real estate that is office lending. So we got sort of a watershed moment on this last week, really from two banks in particular. Domestically, New York Community Bank, NYCB, that stock is down about 60% since January 30th, and today is February 7th. So pretty remarkable. The size of the charge-off they recorded when they reported their quarter was larger than the total charge-offs taken in the previous 48 quarters combined. Wow! And they attributed it to just a handful of pretty significant office property losses. The reason I mention it this morning is because the hits keep on coming. So Moody's has downgraded NYCB actually to junk. Fitch had downgraded Moody's late last week, but only took them to the lowest notch on investment grade. The other bank we got last week was this Japanese bank with a lot of U.S. commercial real estate, particularly office exposure, Azora Bank. And what was interesting about what they had to say, and I touched on this last week, but the LTVs on their portfolios by market were pretty eye-popping. So they talked about loan-to-value ratios being 155% in New York. So this basically means that if you've got a loan outstanding for, let's say, $155 million, the property itself is only worth $100 million. In DC, the LTVs are 172%. In Chicago, 211%. So again, you've got a $211 million loan, hypothetically, against a $100 million property. So obviously, these are problematic type ratios, and they went through a range of other geographies, and they weren't much better. So this is going to be a theme that's going to continue to play out really over the next year or two. Across the regional bank space, it's going to sort of wax and it's going to wane, but it's not going to go away anytime soon. So, that's going to be sort of the fundamental, most challenging backdrop on the credit side for the regionals. Also on credit.
Hey, before you go to the next thing, I mean, just for everyone's edification here, how many years have you been a bank analyst?
Over 20.
Would you ever, or have you ever been able to recommend buying a bank stock without building a model?
Yeah, you need models. I think there's sort of the obvious reason. But then, one of the things you find, right, and maybe, use the word edification for the edification of people listening who might not be as familiar. I mean, the process of modeling out a company is a rigorous process, and going through that exercise routinely, it really does. I guess an analogy would be kind of like in from the old movie The Matrix, when one day Neo just sort of sees the Matrix and it's all very clear to him. When you get into the model of a company, you get a real understanding that goes obviously well beyond the press releases and the headlines. So yeah, it's critical. You're definitely trying to fight with one arm tied behind your back if you're not doing it that way. Any good analyst is using a model. So anyway, moving on to the auto side of things, because we got an interesting update from the New York Fed, just looking at across their aggregate data for the auto lending landscape. And what was interesting about their update is that it sort of reinforced this idea that there's this K-shaped phenomenon going on with, the lower income borrowers, struggling in particular. So they provided basically a transition rate on delinquencies, meaning, how are these? So there's early stage delinquencies, which is once you're more than 30 days behind. Then there's mid stage, which is really going to be more in the sort of 2-month time frame. And then there's late stage. Late stage is going to be up around 90 plus days or 3 months or more behind. And as you look at the roll rates of the transition rates from those early stage to mid stage to late stage delinquency curves, you can, again, gain some insight into sort of the underlying health or lack thereof across different consumer buckets. And so that's kind of what's interesting about the data that that the New York Fed put out. What it shows is that for the bottom quartile of earners, their transition rates on auto loan delinquencies are getting much worse, and certainly relative to other income cohorts in particular. And I guess it's not surprising if you look at what's happened to the average auto loan payment based on the origination of the loan. For low income borrowers, it's gone up the most. It's gone up from $400 on average pre-pandemic to $550, so about a 38% increase. What's interesting is if you go and you look at the top quartile of earners, their payments also have gone up by around $150, but from around $500 to around $650, right? So, it's pretty remarkable that the top quartile of earners average auto payment is $650, and the top or the bottom quartile of earners average auto payment is around $600, right?
Wow.
So anyway, our horses on that one remain Ally and Credit Acceptance. And then finally, we got earnings this morning from One Main Financial, ticker OMF. They too reported, unsurprisingly, ongoing delinquencies. They're basically a subprime focused lender. They specialize in installment lending to subprime customers, either across consumer loans or across auto lending. And their numbers, again, were up pretty decently in terms of year over year. So early stage delinquencies were up from 307 to 326. That's 307 basis points to 326 basis points, 4Q versus 4Q. Their total delinquencies rose from 580 to 616 basis points. And the charge-offs rose from 688 basis points to 770 basis points. So this is a trend consistent with what we've been seeing from other lenders in the space. So we'll get our note out on those guys later this morning. That's it for me this morning.
All right, thank you. Just a good example of being early on the call. We went bearish on consumer credit, commercial real estate on this day like 2 years ago. I mean, so, we're going to be early on research. That's the point. Timing it with the signal is the more important point after you get that first part done with models. All right, Simone.
Sorry, I'm on mute. Hey, Keith, morning. So for me this morning, Rexford, ticker REXR, which we've had on the short side, reported last night. A really shitty quarter for them. So again, this had been probably the highest flyer amongst industrial names, classic roll-up story of a single market. The strategy was always, buying these, older vintage, call them underleased industrial buildings, putting a bunch of money into them and then leasing them up at huge spreads. Well, last night they put out a guidance range that was well below the street, and it's a little funky because they, unlike most REITs, they don't include any acquisition or disposition activity embedded in their guidance, so you have to normalize for that. I was well below consensus, modeling something like 8% FFO growth, excluding any acquisition activity in fiscal 24. And just to size that up, that's a really meaningful deceleration versus what they were doing, right? So they were growing earnings, 15% to 25% plus for several years, just by rolling up a market essentially. And so I was modeling a big decel well below the street, and they came in at 4. excluding any acquisition activity.
Wow.
So it's a pretty bad number. And I was like out there, saying, hey, look, like the consensus numbers don't make any sense. This thing's gonna, decel big time. Like numbers are too high. They need to come down. I thought I was being pretty draconian, and they came in below me. Now, the offset to that is like maybe they're setting up an easy beat and raise. Like at this point in time, I don't really care. They're telling people that they're going to grow same store NOI 4 to 5% and only grow their earnings 4%. I mean, that's really bad. So it's a bad quarter for them. We've had it on the short side. I think it's going to work today and probably diverge from some of the industrial longs we have, and those would be East Group, East Group's EGP, FR and PLD. And we had, kind of, do this too often, but we had said like that was an interesting pair, like pairing Rexford off against any one of those three. And it's probably going to diverge. And I'd imagine Rexford kind of has like a big re-rate today, if my senses are correct. But it's just a bad guide for them. And that's all for me.
Really good research, man. Yeah, and again, for those of you that are new to this, we're not like evil Sith Lord, evil doers on the short side. Nor are we trying to say, like, in the words of Lloyd Blankfein, we're doing God's work here. But I mean, we are doing preserve and protect work. I mean, so when we're bearish on something, that gets people out of names or gets it out of their portfolio so that they don't wear it on days like this and being completely unaware, right? So it's called risk management. So again, it's what we do. We have longs and we have shorts, whether it be VFC or REXR. Those are two good examples. All right. Thank you. Vance Guyver.
Hey, Keith. The video isn't working. There we go. So we have Uber out this morning. So I'll just flag that. We have a bunch of things going on, but Uber is kind of interesting. And they have gross bookings of 22%, mobility bookings up 29%, with good active driver data too, engagement. Active drivers up 30%, and they have a bunch of internal metrics that show driver engagement is up. On the delivery side, which is more Howard's world, but they do have bookings up 19%. The one that's the outlier, which I find particularly gratifying, is the Uber Freight. Bookings were down 17%, and that's obviously a place that reflects the ongoing pressures in trucking. Monthly active platform consumers plus 15%. So basically, all of the headlines out of Uber are pretty robust from an operating perspective. It's worth, I think, noting that we had the Uber IPO as a short, and more or less, I think, left it on the short side until the pandemic. And the reason is that Uber had a complete lack of network effect, which later gets discussed in the book you recommended, the cold start problem. You could run various tests for a network effect, and it just failed them all. And then we moved it to the long side because Uber did, coming out of the pandemic, as the competitive environment eased a lot, it now does show a network effect. I think there's actually just fewer competitors. Lyft is a less relevant competitor, and just structurally, it's performing much better. And the other thing that really drove our move to the long side is that management really wanted to get in the S&P 500. All they needed was GAAP profits to qualify. And if you're really motivated as management, you can get to GAAP profits. And it looks like Uber did it maybe in a higher quality way than I would have anticipated earlier, but that's fine. However they get there, and they did get added into the S&P in mid-December, which was I think the reason a lot of people were interested in it. It's a little trickier here. I think going forward, the stock is up, but the data also, the results look a lot better. And management's obviously in this release trying to put out a bullish catalyst, right? They're promising return of capital, some kind of a buyback coming up. They'll discuss, middle of this month. So, for the moment, I think, they kind of win me over on the data. Not super bullish here, but it is, a stock that's a company that's actually producing better results, better management, better KPIs, even if your sort of S&P edition catalyst is in the rear view. So that's it for me today.
Yeah, that stock, as you know, is bullish trade and trend on our signal strength list. We're going to start publishing that for people to buy on their own. Yeah, the problem with that one obviously isn't the numbers, it's that everybody owns it now. I mean, all these Bozo the clowns that ride it like it, it's kind of like that kind of a stock, and it's just it's what it is. Yeah, these things only happen in markets that are doing what the Nasdaq's doing. But again, they executed and they did their job. So good to know. Good update. Thank you, Zegris. I think you're on for Friedman here.
Yeah. Hey, Keith. I'll try to keep this quick. I got to hop on the New York Times earnings call, but on Snapchat, not a pretty night last night. Top line, after they printed, top line revenue decelerated to 4.7% year-over-year growth from 5.3% in Q3, off of weakness in Europe and the rest of the world segments, which missed estimates by a healthy amount, and decelerated by 1,500 and 1,900 basis points respectively compared to their Q3 results. The company also reported their first quarter-over-quarter decline in North American DAUs since 2019 when they launched their refreshed Android app. North American DAUs fell from 101 million to 100 million after being flat from Q2 to Q3. So obviously that's a huge problem, seeing a declining growth in their user base in North America, which is their most profitable segment. The company also guided to an acceleration in revenue for Q1 between 11 and 15%, but the street seems more concerned about the lack of growth domestically and the rising cost of investments in both their products and their people. Infrastructure costs basically went vertical in 2023 as the company continues to invest in machine learning and AI, across not only their products, but their ad offerings too. And stock-based comp posted another record year at $1.324 billion, which is also the main reason why they posted positive free cash flow for the quarter. Without the massive amount of stock-based compensation that they have been paying out, free cash flow would have been meaningfully negative every single quarter since the first quarter of 2019. Andrew is a great chart of this dynamic up on Twitter, so I encourage you all to go look at that. It's actually pretty humorous. So yeah, really not a great earnings for Snap here, but we'll have more to say on this after we go through the model and update our estimates. And then on the New York Times, they reported this morning, the call just started, but revenue grew 1.3% year over year, which was in line with company guidance, but below our estimates and below the street. This was mainly driven by advertising revenue being down 8.4%, which was a much larger deceleration than the company guided to. But this can be attributed to, one, changes in their fiscal calendar, which resulted in 5 less days in the fourth quarter of 2023 compared to 2022, and very weak print advertising revenues, which have been in secular decline in general, but this was the worst quarter that we've seen since early 2021. Digital subscription revenue remained robust and drove growth at 2.7% or 7.2% year over year. It was the best quarter that Times has had for digital sub net addition since they reorganized how they report their business. And adjusted operating income was really good, beating street expectations by $22 million, coming in at $154 million, and expanding their AOP margin for the full year by 100 basis points to 16.1%. And I'll just say that the guide for Q1 was good with sequential acceleration in digital subscription revenues, total subscription revenues, and digital advertising. So, we'll live a mixed bag here for the Times, but we'll see what they have to say on the call.
Yep. Yeah. I mean, in an election year, for them to be that slow is saying something. It's the economy, stupid. So again, the economy is slowing, but it's not slowing as fast as we thought it was going to slow. So that's called narrow quad 4, or could be quad 1. We'll see how it goes. We've had a quad 1 jobs report last week. We've got a quad 1. Quad 1 is economic acceleration. So we saw that in the ISM services number earlier this week as well. All right. Thanks for the update. Oh, snap. That thing is breaking bad here. Look at that. All right. Balchi, you got anything?
Hey, Keith, we're all set today. Me and Felix are just working on our next idea.
I see him working. He's right over here. He's hiding behind the computer. Are you going to be on, Felix?
Excuse me? Am I going to be on, Felix? Absolutely.
No. Are you going to be on, Felix? I guess Felix is hiding from me behind the computer because he doesn't want to get on the call here. That's what happens when they're doing their work. All right. Thank you. Blanchard, pretty well attended call you guys had.
Yeah, we did. Sorry, I was delaying and unmuting my thing here. I think maybe people like that. That's a good thing,
Yeah, we have all these people that are new here today on the free show. So can you just explain what that call was about?
Yesterday's call.
Yep.
Yeah, we were just going over the upcoming argument tomorrow, 10 o'clock in the morning in the U.S. Supreme Court, and it's on whether or not Donald Trump would be disqualified from holding office, even if he wins the election. And obviously, that would have huge ripple effects on the campaigns and people's expectations of what they're looking at in the fall. And everyone assumes it's a Biden-Trump rematch, and all of that could be upset if the Supreme Court rules that Donald Trump is ineligible to hold office. So we were going through the legal issues. We think it's a very close legal case. There's some, political factors, and I think the general, the conventional wisdom is, he's gliding to the Republican nomination, and millions of voters who would support him. So how could the court possibly even consider stepping in here and disqualifying him from holding office? And the answer is, based on the law, it's actually a pretty close case. And if they, go that direction, people have to take seriously that prospect. We think it's plausible. And then it would shift to the Congress to 2/3 vote in both houses under the Constitution would restore his eligibility to hold office. And already, I don't know if you saw in the news, but Matt Gaetz and others, Elise Stefanik, Trump supporters in the House, have already begun the process of getting a resolution going to essentially do that, to make sure that he'd be eligible, even if the court rules that he's ineligible. And I'm wondering, obviously, I assume that's coordinated with the Trump folks. Maybe JT can comment on that, but is that some sign that they're a little nervous? The court is going to do this, so we'll know a little bit more after the argument tomorrow at 10 o'clock. And we were just going over the legal issues as best we could do it at a high level, and the political considerations and the fallout, how all of this would potentially, change the dynamics of the election and the campaigns, and potentially who would be sworn into the office, next year if this happens. So
yeah, Paul, just talk about the Veep aspect. If it does go into the House, if that resolution, if this restoring Trump resolution doesn't pass, even though they bring it forward this year, right now,
yeah,
it's not going to have 2/3 votes. It might pass, but it won't have 2/3. Just tell everyone what happens if that doesn't pass in January of 2025.
Well, yeah, if by chance Trump, because again, the Constitution says that if you're an insurrectionist against the Constitution, you are disqualified from holding office. And if that's the case, and he actually still runs
and wins,
I mean, it's theoretically possible. I'm not sure it would really play out that way, but it's theoretically, if he hung in there and did that, then he couldn't take the oath of office. He's ineligible. So under the Constitution, the vice president he runs with, assuming he's not an insurrectionist or she's not an insurrectionist, say Tim Scott or Kristi Noem, whoever, they become the acting president if that happens. If your president-elect is not qualified. So that's how that plays out. But we were covering, for example, that issue and numerous other issues. Could it incite a third party to come into the race? Could that lead to a lack of anyone getting a majority of electoral votes? It would go into the House. How might that play out? So we covered all of those permutations as well. It would be an incredibly dynamic and fluid situation if that happened. Again, I think people go into tomorrow morning thinking there's just no way that all of this can come to pass. Maybe that's right. Maybe the Supreme Court will say, Trump's not disqualified, overturn the Colorado court that did disqualify him in that state. But, if they do rule that he's disqualified, affirming the Colorado court, it's going to dominate, the news flow and everything for the next several months.
These are the black swans or the gray swans that,
yeah. And, you think about it, because people are already modeling in the impact of Trump tariffs if he gets reelected, if he gets elected. And inflation, economic policy, net neutrality dies if the Republicans win. The FCC regulatory policies, all antitrust enforcement on the big tech companies, all of this kind of stuff changes depending on the election outcome. And people are beginning to model all of that out. And this could just completely upset people's assumptions of what's potentially coming.
10% tariffs on the EU, 20 to 60% tariffs in China.
So that's what we were covering on that call. It's up for, I think, replay. And I think it's as people get ready to tune into this thing tomorrow at 10 o'clock. I think it's a great backgrounder on what to be thinking about and how to listen to it. I think if you're interested in that in a constructive way. So that's what we were doing yesterday. I do want to say very quickly, there's been some news about ESPN, Fox, and Warner Brothers putting together a joint venture for streaming sports. Probably absorb more than half of the major league sports rights and such out there as a separate streaming service. No pricing yet, and it's shaking everybody up in terms of not just the streaming world, because sports is very sticky. Subscribers who take it, they keep it. It's a pretty big deal, but also obviously potentially adverse impact on further the traditional cable bundle, because sports holds a lot of that together for people who still subscribe to it. The thing that people haven't talked about yet, and I'd like to see the details as this plays out, is from my understanding, is the leagues were not necessarily in on all of this. If you think about what they're doing here, I mean, these companies, Warner, Fox, ESPN, which is Disney, they compete against each other for sports rights, basketball, NFL, baseball, hockey, even. And I think that, there may be some concern there if these guys are not competing against each other as aggressively for those sports rights. So if you're a league, is this something that you find attractive? Do you find anti-competitive? I'd just be curious to see what, the details are and how the leagues react, and actually how the regulators might, have questions about it, when these details come out. So it's something to think about as, people jump all over this thing. Be careful. It may generate some inquiries.
All right. Good to know. JT, anything else?
No, that's it, Keith. That's it today.
All right. For those, again, thanks for those of you that joined us today. Our commentary, especially on that last part, is not political. Again, unlike most people that just run their mouth politically, on this topic, Paul's, legal expert. Okay. So that's his view. And we're just trying to risk manage the event risk, which is, of course, tomorrow. So we'll stay tuned and we'll keep you updated on that coming in and out of that event. And thanks for joining the call.